Blowout earnings from Nvidia gave risk appetite its latest leg higher last week, helping indices on Wall Street to fresh record highs, while stocks in Europe and Japan joined in the risk-on rally as well, rallying to fresh all-time highs of their own. Elsewhere, rates continued to ratchet higher at the front end of the Treasury curve as the market continued to hawkishly reprice its Fed policy expectations. But despite that, the greenback slipped to its first weekly loss of the year against a basket of peers. Looking ahead, another busy one awaits the financial markets, with inflation figures in the United States and the Eurozone highlighting a data docket that's packed full of interesting releases, plus a busy slate of central bank speakers to digest once more. Plenty, as always, to discuss on the trade-off this week. So without further ado, let's get into the show. Well, the risk-on rally continued last week and looks set to continue into this week as well, with equities starting the week on the front foot. Joining me, as always, to make sense of everything that's going on, now that his alarm's finally gone off, is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, well, basically, good evening to you at this point, mate. How are you?
Oh, you're going to be milking on this one for a while, aren't you? Just because I was a couple of minutes late this afternoon by, 30 seconds or so, and the world's ended already. But I'm good, thank you very much, Michael. Maybe you can send me a watch. And
well, exactly. I was going to say what I'll do. I'll wander into the Pepperstone office there, and we'll have a whip round, and we'll see if we can get you one of those Mickey Mouse to and past watches, so you can learn how to tell the time. In all seriousness, though, we do have plenty to discuss on the show this week, so let's get into topical thunder. So there's really only one place to start this week, and that is with the equity market. Of course, Nvidia's latest earnings report was the main focus of last week, as we discussed in the show this time last week. It was billed as the most important stock in the world by the folk over at Goldman Sachs, and I sincerely hope that they were being quite sarcastic in that description. But however you describe the chip maker, they smashed through market expectations, with Q4 revenue about $1.5 billion ahead of where analysts had expected it to be. Data center revenue up well over 400% year on year. EPS coming in at 516 against a 460 estimate. And not only did you have some earnings beats, but you also had really, really strong guidance for the quarter ahead as well. Nvidia now seeing Q1 revenue at about 24 billion compared to the just shy of 22 billion that had been expected. Now, of course, they have absolutely flown higher and gone on an absolute tear since the report, up around 20% in the last couple of days of last week. The market cap of Nvidia is now north of $2 trillion. And just to put that into some kind of perspective and context, that gives them a market cap that's about 10 times bigger than that of Intel. And if you look at how much that market cap has grown over the last 3 days, it's about 250 billion. And that is the entire size of Netflix that has been added to Nvidia just since that earnings report. The numbers we're talking about here are absolutely staggering. And of course, it's not just Nvidia that has rallied since that earnings report. Chip makers more broadly have moved higher in sympathy. And of course, now that we've navigated that key risk, we've seen the market more broadly at an index level also rally quite significantly. The S&P 500 back at an all-time high, the Nasdaq 100 north of 18,000, the Dow, dare I mention it, that's also at a record north of 39,000. But I think what's more interesting is that this isn't just a US-only story anymore. We're actually starting to see the rally broaden out into other geographies. As I mentioned in the intro to the show, the Stock 600 here in Europe, that's at a record. The DAX is at a record. The Nikkei is at a record over in Japan for the first time in 34 years. You've pretty much got a record high left, right, and centre at the moment, which begs the question, can the rally continue? It won't surprise you to think that it can. I think the next main risk for markets is probably the payrolls number, which comes out on the 8th of March. And barring perhaps a little bit of consolidation and rebalancing into month end this week, I think the path of least resistance clearly leads us higher. But Ryan, I'm keen to get your views on that as well.
Yeah, well, obviously the FTSE is seeing record-breaking highs as well. But 8,500. Back to reality. And every time I look at it, it's trading at 76 something. But yeah, everything else off to the moon. I mean, you mentioned how much market cap it added on Nvidia. I think it was 277 billion by the close of earnings day, which is bigger than the GDPs of Greece, Portugal, and several others, let alone other valuations for individual companies. So yeah, these numbers, they're mind-boggling. I wouldn't mind being a tenner behind those guys, but yeah, I mean, we talk about these numbers, and it just boggles the mind. Oh well, only 24 billion they're gonna expect next quarter. Yeah, and the market will go potty if they miss by a couple of million, and that's the funny thing here. In terms of the reaction since, everyone was waiting for this, it came in good. You've got to ask what next. What more can the markets do now to keep maintaining these highs? Yeah, obviously, if Q1 is still good, then that's going to continue things on. But and I know Blake's been getting a bit suspicious of this. Maybe we're going to head to a possible territory where we see a little bit of a blowout to the upside, and then that then clears everyone out to get a big trend refresh. But yeah, for the moment, there's different things happening. Yeah, stocks 600 may be moving, but I think the Nikkei is a different kettle of fish altogether. Yeah, they've got big investment in chip plants going on over there. So that's something that obviously investors are getting very excited about. TSMC obviously opening up some huge plants and they're offering huge subsidies over there. Then we've got the Bank of Japan situation coming on. So yeah, at the moment, broadly, it's good risk times for stocks, and you've got to ask where does this all end?
Indeed. I'm glad you brought up Mr. Murray. I'm due to be speaking to him at some point this afternoon, and I will happily take the other side of that call if he does think we are near a top. But I'll have that little charity bet with him later on. Right, let's move on and drive forward into the auto sector. And before we do, let me just say bravo for your own pun at the bottom of the screen there.
To take my limelight and spray one in yourself. But it's talking about a potential lack of spark in the EV market. I'm pretty proud of that one. It's
I can tell. Is that why you were late? You were thinking up the pun, is that?
Oh, no, those come to me pretty quickly, as you have to learn in this show. So, yeah, don't you worry about that, old China. Right, so this one, perhaps not quite the canary in the coal mine that Westy and Blake spoke about regarding commercial real estate in the US last week, but the auto sector is starting to ring a couple of alarm bells for me. Firstly, sales have been very strong for the last couple of years, record numbers in the US for 2023. So you've got to wonder, where am I seeing these warning points? However, coming into 2024, there are some signs of that fading, that strength fading. We've got General Motors who have pushed back the launch of some Chevy models. Ford have apparently cut production of their F-150 Lightning EV pickup by some 50%, as well as all these companies throwing in additional discounts. Tesla have started running some additional discounts. So despite that, the prices of EVs are still run significantly higher than combustion cars, and some of the new kids on the block are also suffering. Firms like Rivian and Lucid are seeing investors flee from their stocks. I think Rivian's down some 50% since the start of Q4. Lucid down some 30%. So as I say, some of these new upstarts are feeling a bit of heat here as well. Now, if you add to that in the sector the bumper auto worker pay deals that we saw late last year, we've got automakers who could be facing a bit of a double whammy from falling sales while battling those extra wage costs. And this is in a sector that it's constantly walking a cliff edge and has been really bad since COVID and before. So I think in this high interest rate world where weaker consumer spending is one of the first signals that rate hikes are biting, something like the EV market could be one of the early indicators that consumers are starting to watch those pennies. As it's always the most expensive items that stall first as well. If that happens, we could get a bit of a domino effect spreading through all levels of the auto sector, and that could have clear negative economic consequences for the rest. So just some early warning signs to pay attention to as we head into Q1.
Yeah, indeed. I think it's interesting that you brought this up. You've clearly done your homework over the weekend, mate. This is not something by any means I'm an expert in, but what I would say is I do think the other thing that may just be worth considering, even just at the margin, in terms of auto sector and particularly EVs, and I know this is the case here, I think it's the case in the States as well, is just the degree of state subsidy or tax credit or government reimbursement or however you want to phrase it, and whether that changing and all the rest of it may be being reduced, may be impacting sales a little bit. But yeah, I do agree. It is those big ticket items that you do need to watch as the early signs of consumer spending starting to soften and roll over, if it is indeed going to. And I think it's something that's well worth keeping on the radar over the coming sort of weeks and months.
Yeah, I was going to ask you, are you old enough to pass your test yet? I'm not sure. Will you even be driving one of these?
Does a golf buggy count as an EV?
I told you I'm quicker on the quips than I am on turning up today. But yeah, I mean, there are other problems widespread. China, we've seen those. We saw about ghost cities in years gone by. Now we've got ghost car parks full of EV vehicles all going to rust. Because they're not being sold, and as you say, heavy subsidies coming over there in China as well. So yeah, globally there's some warning signs coming in, and we'll have to see how far that comes into things.
Absolutely. You talk about ghost cities. The city of London feels like a ghost town today. There's no one here. People, come back to the office. The city needs you to breathe some life into it. Right. In any case, before I get told off by HR, let's move on. I want to talk about the dollar, and I want to talk about the dollar index. Now, I know it has its flaws, and I know Ryan likes to moan every time I bring it up, but it's just an easy and maybe even lazy way to just track the strength of the greenback against a basket of peers. But what's the most interesting thing is that the dollar index notched its first weekly decline of 2024 last week. And of course, that begs the question as to whether this is a blip in the bull run that we've seen since the turn of the year, or whether this might be the first little tentative sign that the tide may be starting to turn against the greenback. Now, personally, I would argue for the former, in that this is merely just a blip. I think you've got to remember that the dollar has come a pretty long way in a pretty short space of time. The dollar index was up around about 4%, just under 4% on a year-to-date basis when we got to those cycle highs at the beginning of last week, just shy of the 105 handle. And when you think about how generally slowly the FX market tends to move, to go 4% in 6 weeks is a pretty chunky move, I would argue, for most G10 currency pairs. So I guess it's no surprise to see that some longs wanted to take a little bit of profit off the table. And I think maybe one of the telltale signs of that is that if you look across the G10 board, look where the move started to stall out. The dollar index at 105, cable at 126, the euro at 108, the Aussie at 65, the Kiwi at 61-ish. All those kind of big figure levels are where you would naturally expect people who had been long for a while, or short, depending on the currency pair you're looking at, of course, to actually think, no, happy with where we've got to, going to de-risk a little bit, lock in some of the profit that I've got on board. Overall, though, I still see little reason for the fundamental dollar bull case to have changed. You've still got rates moving higher at the front end as the market reprices its Fed outlook, those cut expectations continuing to be pushed back. And interestingly, the easing cycle starting to become a little bit shallower, as we had discussed in the show a couple of weeks ago. And of course, this comes as disinflation continues and the economy remains on track for a soft landing. So that's one part of the jigsaw for further dollar upside. I guess the other question is, what else in G10FX would you want to be long of at the moment? And I can't really come up with an answer to that, to be quite honest with you. The ECB look like they may cut in April. The Aussie and the Kiwi are going to struggle, you would expect, as China remains in the doldrums. The Bank of Japan taking their time to tighten things up, and don't even get me started on the Bank of England. So I think that the move we saw lower in the dollar last week is merely just a bit of a blip, and we should see that given back and the dollar make a resurgence in the relatively short term. What say you, Ryan?
What say me? I think you're right. I think we're into one of these periods. I'm going to talk about it in a moment, where just the markets have had their move around. We were pricing Fed cuts and we priced out Fed cuts, and now we're doing the same with the rest. And the market's still jumping around with all these when are they going to cut story. So yeah, we've seen this year, the dollar was particularly strong, and now we're seeing a bit of a relief from that. So markets, to me, it's natural moving markets. Markets go up, markets go down. You're not going to get trends happening forever and ever and ever. We're still in the same old ranges at the moment. I know your DXY big levels that some of the folks here at Forex Analytics talk about, 103.80 on that one. So we're heading around that area at the moment. While we stay sort of there or there above, then things aren't looking too bad for the dollar. And then on the top side, you got what it is, 105, I think, as you mentioned, is the big one there. So we're all walking around the ranges, and markets like to move within ranges. And I think for traders, you've got to know that, you've got to sense that, know where your range edges are, and stick to those range edges, because if they hold, then that's going to keep your prices contained and give you a trade.
Yes, exactly that. Profound insight, as always, from Ryan Littlestone. Markets go up and down. That is why we have him on the show, ladies and gentlemen. And you know what also goes up and down? Interest rates. And that's exactly what he's going to get onto next.
Well, I was going to say, if you were saying that you didn't know what else to trade, I thought we were going to call the show early. But obviously, we're going to continue.
Well, we can. Off you go.
That'd be a good one for me, in late and out early. Yeah, perfect day's work for me. But I'm going to talk about the RBNZ and whether they're going to hike or not, because it's probably one of the most intriguing central bank meetings of the recent batch. There's some pretty heavy hawkish expectations for a hike by these lot. ANZ have expected them to hike twice over this meeting and then in April. TD Securities sees a hike this week and then again in May, but cuts are still being deliberated over, with both ASB Bank and BNZ banks both moving their cuts from back to November from August, so delaying those cuts. Now, I've looked at the data over the weekend, and inflation data remains well into sticky mode. In fact, ANZ's commodity price index has risen 2.3 and 2.2% month on month in the last 2 months. The food price index broke a 4-month losing streak with a near 1% rise last month. Labour costs for Q4, they came in lower than Q3, but came in hotter than expected, and the quarter-on-quarter number was up 2 pips over the 0.8% in Q3, so another 1% print there. Q4 CPI, that came in as expected, a drop to 4.7% from 5.6%, but it's still running very hot in RBNZ terms. PPI remains sticky. Now, there were some negatives in the data. There was higher unemployment and some pretty soggy retail sale numbers. Now, the RBNZ themselves remain concerned about sticky inflation, and at their last meeting opened the door to hikes by saying that if inflationary pressures were to be stronger than anticipated, the OCR would likely need to increase further. Now, for the Kiwi dollar, we saw a decent jump over those ANZ forecasts changing, bringing those hikes to this month. So it's possible that should they hike, we might get a bit of a buy the rumour, sell fact situation, although I would still expect a jump in the Kiwi on a confirmation move. Now, conversely, if they stay on hold, that could see the Kiwi come off a good chunk unless they increase their hawkish rhetoric or tee up one of the future meetings for a hike. Now, I think there's definitely some two-sided risk to this event, and likely it will be more exciting than the Fed or the ECB meetings, at least.
Yeah, well, that's a very low bar, mate, if we're being honest. I mean, if I painted that wall over there and watched it dry, it'd be more interesting than most of those. I'm not going to talk too much about the RBNZ because that's the first thing I want to cover in the next segment. But what I will say is if anyone knows what they've been drinking or smoking over at ANZ to come up with, or TD Securities to come up with these calls, answers on a postcard or down in the comments below because we might want to try it. Anyway, let's move on to That's a Setup. So picking up very nicely from where we just left off, I want to start with a look at the Kiwi dollar. It's almost like we plan and rehearse this show, as Ryan has just very comprehensively covered. We've got the RBNZ decision in the very early hours of Wednesday morning. It's going to be exciting, but Ryan, are you going to be staying up for it?
Oh, absolutely not. No chance.
Well, given how ropey your alarm is, I doubt it would go off anyway. So,
sorry, I had to. For it anyway.
Exactly. Right, back to the markets. As Ryan said, it is delicately poised. If you look at the OAS market, pricing at around a 3 in 10 chance of a hike. So I'm going to call it a live-ish meeting rather than a live meeting. But I think the Kiwi dollar is pretty delicately poised going into that RBNZ decision, given that we sit right on this 62 figure, although we have backed away slightly below that level this morning. Personally, I think it's a little bit loopy to expect the RBNZ to tighten further. They've already done enough, I think. Inflation is coming lower. Inflation expectations are starting to move back towards target. And also you're seeing real signs of the economy struggling. The Q4 resale sales number down almost 2% was cataclysmically bad, if we're being honest. And of course, the other thing you've got to remember is the issues that are going on with China, which we certainly don't have time to go into now. But I think the risks are pretty much two-way here. I think if the RBNZ were to be more hawkish or even deliver that hike that some out of consensus calls were expecting, then you're going to see us rally. I think you're going to see us go back towards those cycle highs, maybe even as high as the 64 figure in a move that would likely last a few days, particularly if the guidance is that this is the resumption of a hiking cycle rather than a one and done hike. And if you were to play that from the long side, the 50-day moving average at 61.80 is a nice level to use as a stop. On the flip side of that, if the RBNZs are a little bit more dovish and actually come out and say, we think we've done enough, you're going to see that 15 basis points worth of tightening that OIS has in the curve come out. And in that case, I think you'd be looking to short the Kiwi dollar, probably on a closing break below the 50-day moving average, put the stop just north of the 62 figure, and actually a decent chunk of those gains, which extended into a ninth straight day on Friday. Looking at that chart, I think they would be given up in relatively short order. So I think we've covered everything there is to cover about the Kiwi and the RBNZ there, haven't we?
Well, nearly, I think, but no doubt your postman's going to be getting ready for another flood of complaint letters after insulting the banks this time. You do have it in for those guys over in New Zealand. I don't know what it is, but it's disgraceful if you ask me. But
they're lovely people.
Each to their own. So I'm going to assume that you're not expecting hike from these guys. So you're firmly in the hold camp.
Yes, correct. I'm not expecting them to hike. I think they've probably done enough. I think I can't remember which sell side research note it was I was reading now, but it said the RBNZ's bark is going to be worse than its bite, and I think that's probably about right.
That's probably about right with that pun to move on, I think.
Go on, let's move on to the yen.
Yeah, going to move on to dollar yen, which is stuck in a bit of a rut at the moment. But it's been acting rather strange recently. It's only modestly reacted to data, central banks, yield moves, and some strong jawboning from Ministry of Finance officials. A lot of that lack of movement, I think, has been down to the cross currents, cross pairs, as the market sort of rejigs, cut expectations for other central banks, just as it did for the Fed. But the standout for me last week was the complete lack of reaction in yen pairs to these early wage negotiations. Several firms, including automakers and retailers, have agreed wage rises well in excess of last year's pay hikes, and the yen didn't even blink. So I continue to have a bit of a growing feeling that when or if the BOJ turn late spring, as many expect, it could be one of the biggest disappointment trades ever. There's also the not so low risk that they don't act at all, and if the data doesn't play ball on inflation and wages. So I'm already looking at some cheap upside option coverage just in case we get those very events. Now, in the meantime, dollar yen is stuck like glue around this 150 area, but it does remain in a very strong uptrend, and that's not to be ignored as we're still close to that massive double top at 152. Now, due to the upcoming BOJ decisions to be made, and of course what happens with the Fed, it feels like one still can't really pick a side and stick with a view longer than 5 minutes. It's still costly to be long yen for any length of time, and it's risky to be short ahead of the BOJ and with this increased Ministry of Finance chatter. Hence why playing the options with maybe a 6 or 12 month tenor and a very wide price range might be the best play moving forward for this one.
Yes, it's an interesting one, actually, and we don't talk about options enough on this show. I mean, obviously, you can't trade them with Pepperstone at the moment, but they are a very important tool in the arsenal, particularly if you are a sort of more advanced and experienced trader. It is something maybe worth considering. I think the move last week was interesting, or the lack of move, I guess you could say, and it just speaks to when you're trying to identify the drivers of the yen and yen pairs at the moment. What is it? Well, if it's ignoring what's going on in terms of those wage negotiations and ignoring what's going on in terms of domestic factors, it just reinforces my prior view, which is never a particularly comfortable position to be in, if I'm honest, where the yen is just a rates trade at the moment. And I think all the time you're seeing the front end of the Treasury curve continue to sell off. Dollar yen is firmly biased to move back to the upside and reclaim and take out that 152 level in relatively short order, you'd expect.
Yeah, very possible. And, we saw last week that we did get decent rallies in other yen pairs, which are, as I say, I think, the lot going on in the crosses more related to other countries, ECB, BOE than the likes, as the main driver. So when you do see this one sitting doing nothing, when other signals suggest it should be doing something, that's when you need to perhaps look at elsewhere and see what is actually driving the yen at the moment. But that 152 is looking a bit juicy at the moment.
Yes, indeed. Right. Well, speaking of driving, let's have a look at crude. That's a bit of a crude pun, but let me get away with it. We are.
It's terrible stuff. Oh, it's going downhill really fast here.
It really. I'm not sure it ever went uphill today, to be quite honest with you, mate. Right.
Well, if you were driving anyway.
I've totally lost this. Right, WTI, where are we? We're back at $80 a barrel for the fourth time in as many months. And it's that same old film all over again. We've got supply worries that drive us higher into this $80 a barrel mark, at which point everyone goes, maybe geopolitical risk is accurately priced. And then on the other side of the coin, you've got no one really wanting to be short crude, be it WTI or Brent, incidentally, in any sort of size or with any sort of conviction, given the geopolitical backdrop, which makes being short oil a little bit of a perilous position, particularly given that the situation in the Middle East and the Red Sea could still flare up at any moment. And that leaves us in this kind of no man's land, really, between, you could say, $75 a barrel. I would argue the 50-day moving average, which is about 75 cents below that, and the $80 a barrel handle to the upside. No one really wants to break us to the bottom of that range, and no one really wants to break us to the upside of that range either. You could argue that we've been trending steadily higher over the course of much of the year, as that white trend line would indicate, but it's been more of a grind rather than any sort of impulsive move. So I guess the question then is, where do we go next? Well, I still think that if we are going to get a decent and prolonged break north of that $80 a barrel mark, it is probably going to need a more decisive pickup in demand, particularly given how we've seen those supply-induced rallies get faded relatively rapidly. So on that front, we've got PMI figures out of China on Friday. Keep a very close eye on that towards the back end of the week, particularly in the manufacturing sector. I think the near-term balance of risks, and I mean really near-term here, does perhaps favour a move back down towards that 50-day moving average, which comes in just north of $74 a barrel. But again, the old adage must apply that if you are going to be short crude at this moment in time, or even have a bearish bias on crude, it does require incredible agility with that trade, and also likely a much smaller position size and a much tighter stop than you would perhaps usually trade with, given the prevailing geopolitical environment.
Yeah, and this one, again, it's probably had one of its quietest periods for quite some time, which is strange for all, because it doesn't mind busting a move in this one. But, the chart speaks for itself. We've had four big goes at this 80 level. It's held. It's shown you where the range is going to be. When we get down into sub 70, that the market starts talking about the bid and filling up the SPR and where they're going to start buying. So you can never discount that from it, and that keeps it in range. So it's got some decent trading range levels to pick from, down into 70, set it up into 80, and keep doing that for as long as it works. Where you have to be careful is you do get some news dropping, like you say, easing of the tensions in the Middle East, then we're likely to see oil dropping down a bit. Then you get the demand picture coming in as well, which isn't too hot, and that's going to outweigh everything in the longer term. And I don't think demand is going to step into the breach, as we should say, in this instance, because we've seen from the manufacturing numbers some improvement in the PMIs, but very few still sitting above that magic I've forgotten what it's called now. Not contraction, expansion level. There we go. Get there in the end. So on the demand side, until we start seeing those PMIs really taking off and seeing some real growth there, then I think the demand picture remains weak for this one. So if I was trading it, and I'll trade it now and again, set yourself down into those high 67s, low 70s, and sell them up into the 80s.
Yep, I think playing the range is definitely the way to go. The other thing, just while we're talking about crude, is, and we haven't got the chart in the deck today, but dollar CAD. It's gone nowhere for about 6 weeks now, primarily as a result of crude also going nowhere, and the fact that the BOC and the Fed tend to move pretty much in lockstep in terms of policy. So there's no real yield differential to play there either. So it's not just crude where this lack of vol is having an impact. You're also starting to see it feed through into dollar CAD, but the FX market more broadly is also pretty quiet, isn't it?
Yeah, very much so. And volatility is what I want to talk about now, because well, everyone is still playing this wait and see game over the rate cuts. It's what that's doing is lowering volatility, which isn't very good for us. I'm looking at the on the chart there, the 1 month at the money vols for euro dollar, and we're now pretty solidly below the 6% level, and we've got as low as 5.4% last week. Now, the pivot level between sort of where volatility is higher and lower is around 6 to 7%. So being sub 6% is why we're seeing euro dollar staying in very tight ranges intraday. Now, watching the volatility numbers are very important, as I use them to determine how markets may react. So in between data points and news headlines, things will stay calm in this environment of low vol. So we need to factor that into our trading expectations. Low vol means that we may have to adjust our trading strategies. You know, whereas a data point coming in an 8% volatility market might bring a 40, 50 pip move, in a 5 to 6% volatility, that might only be 20, 30 pips. So in that sense, it means we need to perhaps lessen our profit expectations in a trade. Now, I think we're set to continue this low volatility environment until we get closer to the point where central banks are going to be taking or talking seriously about their rate cut timing. We also have the Bank of Japan factor, which is keeping Japanese yen vols just that little bit higher. So when things are slow like this and the volatility is ebbing away, adjust your trading strategies to match. Keep intraday profit targets realistic, but also look for any blips in price moves to range edges over big data points or central bank events, something that kicks the price up to a level that you might not get otherwise. And if you get to those range edges, think about that vol and think about what trade you're going to do there.
Yes, indeed. I think vol is an interesting story at the moment. I think the lack of volatility in the FX market is obviously quite annoying. Trading conditions are very turgid indeed. I think more broadly, though, the fact that everyone knows or prices that we're going into this relatively synchronized, coordinated easing cycle from now until kind of Q2 2025, at least that's what the market is now pricing in for most major central banks. Yes, there's going to be a bit of divergence between the pace and the extent of those easing cycles across G10, which could ignite a bit of vol in the FX space. But I think it should keep a bit of a lid on vol when you look at equities and when you look at fixed income. And I think that, coupled with the fact that the policy backdrop becomes more supportive, should see equities continue to rally. So I know I've gone totally off-piste there, but there you go. There's my thoughts on vol. I think it will remain relatively subdued, barring, some kind of either big divergence in policy. If you see the RBNZ hike, for instance, or the BOJ come out and say, we're going to hike 25 bips a quarter, then, yeah, you're going to see things shaken up a little bit. But unless and until that happens, I think it should remain relatively calm. And I really hope I haven't just jinxed that. Although I'm sure there's actually people out there hoping I have.
Yeah, I hope you have as well. I mean, it's part and parcel of markets. You've got to think of volatility around fundamental events, a bit like a dropping a stone in water. Inflation has been the big brick in being thrown into the water, if you think about it. And when that happened and central banks had to start hiking, that's when vol increased. And, the ripples from that just slowly subside. And that's what's happened to volatility. But we shouldn't get too downbeat about it. It just creates different opportunities and different ways that we have to trade to try and utilise that lower vol. Stick it to tighter ranges. If you get in tight ranges in euro dollar, upward towards key levels, we'll talk about some of those as well, then it lets you know where you need to either take profit or maybe even factor a trade in, and you can do a lot more short-term trades while volatility is lower.
Yes, indeed. Adaptability. Adapt, improvise, and overcome, as they say. Right, let's move on to our plays of the day. And yes, I said that slowly and in a weird way because I didn't have my play of the day in front of me and I was stalling for time, hoping no one would notice. Right, I will have a look at the Nasdaq this week. I feel like I sit here every week when I'm preparing for this show and go to myself, how can I say be long risk, but in a slightly different way? And this is what I've come up with for you this week. We're looking at the Nasdaq 100 here, but we're looking at how it is trading in relation to rates. And I think what's really interesting is that since the start of February, the Nasdaq has continued to rally, as we know, chip makers and Nvidia leading the index higher. But that's come despite treasuries having sold off in the 2 year, as you can see here, by about 50 basis points since the start of the month. And I think this is an interesting one because, as you can see, the correlation between lower rates, higher equity, higher rates, lower equity, particularly in the tech sector, has been a very, very tight one for some time now. And the fact that that's starting to break apart and has broken apart in a very, very significant manner, that suggests to me that the tech sector is no longer as sensitive to, or perhaps even reliant on, rates being low and falling as it was earlier in the cycle. And maybe that's because the tech sector has now pretty well proved that it can deliver on and actually beat earnings expectations no matter the rate environment that we're in. So I think there is perhaps, therefore, no need to really worry too much about a further hawkish repricing of Fed expectations if you are long equity. And as I said earlier in the show, I think the path of least resistance is still going to lead us higher into that non-farm payrolls number on the 8th of March. Right, Ryan, I said we'd said everything we could say about the Kiwi dollar earlier, but clearly we have not.
Yeah, nearly said everything about the Kiwi. So, yeah, might as well stay Kiwi-centric today, as it's possibly one of the bigger market-moving events this week. I'm looking for a fade on a potential hike move from the RBNZ with a long down in Aussie Kiwi, down into the 105, 104.70 area, which has been a historical traffic zone for this pair. Now, the RBNZ would have to be really uber hawkish to see a sustained strength in Kiwi. And I don't think they have a need to be, as you set out as well. They need to be attentive to inflation, yeah, but embark on another hike cycle, I don't think so. Now, should the price go my way, I'll be looking for a fairly swift return back to the 106, 107 area. Now, given the volatility we can get in Kiwi, I'm preferring going with a smaller trade size to allow for a wider stop, just to maybe stay out the way of any sort of volatility trouble. So stop looking at maybe somewhere perhaps subs 104, and that would allow me to keep my normal risk parameters just by lowering that trade size a little bit. So, yep, looking at potential long on a hike to fade.
Good stuff. Well, that does bring us to the end of another show. Thank you very much at last to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, not only for bringing this show together as brilliantly as he always does, but keeping me company while we were both waiting for the great man to join us a little bit earlier on. Hope you've enjoyed the show.
On and on. I'll tell you what, the next time you do something, I'm going to have it pictured up here. It's going to be on the screen behind me. It won't be the Bank of England and Cornell. It's going to be your big blunder front and centre there. You wait, mate.
Of that I have no doubt. Revenge is a dish best served cold. Even if I could say it. Right, let's bring this show to an end before it all really falls apart. So hopefully you've enjoyed the show. If you have, please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets or if there's anything you want us to cover in next week's episode. And that is indeed when we'll be back with another episode of The Trade-Off this time next week. In the meantime, thank you very much as always for watching and goodbye for now.